one of the points I guess I was trying to make is that you don't necessarily even need to go through the whole discounted cash flow thing in every case. Everybody knows what a PE is, PE ratio, price to earnings. You can compute that a couple different ways, whether it's the market cap of the company divided by their last 12 months earnings, or simply the stock price divided by the earnings per share. It gets you the same number. The average long-term PE for the average company across the last 100 years is right around 15. Neutral Tandem a week and a half ago was trading at a PE of 13, meaning the market thought it was a less than average company is one way to interpret that. Here's the math. There's the market cap. There's your trailing 12-month earnings. And if you just divide those two, you'll come up with that PE of 13. If something's got a PE of 13, then it's arguably fairly cheap already. What was even better in Neutral Tandem's case, though, is that they had no debt. They already had $161 million of cash on their balance sheet. If the company did nothing else but service its existing clients for the next 4 years, it would then have an amount of cash on its balance sheet equal to what the current stock price is. The issue, though, is, and I love finding opportunities like this because PE doesn't always tell the whole story. It's just a very rough, blunt tool. If you adjust the PE to account for cash, sometimes that can be a great way to find companies that you might otherwise find, and Neutral Tandem was one of those things. Had about $161 million in cash, or about $4.75 per share. Again, the stock at the time was right around 15. The cash-adjusted PE then is really 9. So what looks like something that's cheap and attractive with a PE of 13 becomes very cheap, very attractive at a PE of 9 once you take that cash out of it. And the other point is, all of that is another way to say that the earnings yield, if you take the PE and invert it, that will give you the earnings yield. And that will basically tell you the stream of earnings that you're going to receive by buying that company at that price. An earnings yield of 11% it just seemed way too cheap for Neutral Tandem. If the company had a lot of debt, I wouldn't pay much attention to cash, just PE. It would balance itself out in the capital structure. The reason it's relevant here is because Neutral Tandem had no debt, and that cash is specifically something that you can really take out from the equation. This is how all the private equity guys run their businesses, by the way. They will look at a company and that has, in Neutral Tandem's case, here's a market cap. If you back out the $161 million in cash, then you can buy the company for $369 million basically, by buying the company and paying for part of it with its own cash. And that's the whole leveraged buyout private equity model. So think about things in a similar way. If you're going to buy a house and one of the rooms is just loaded up with cash, then you can agree on a price, and then at closing, just bring that cash in that room and pay it down. Same sort of principle. You can get things a lot cheaper than you otherwise would. Theoretical point. The reality of it happening would be probably far-fetched for a lot of reasons, but the point being it's creating enough cash just based on what it has right now that it shouldn't be as cheap as the market seems to think it is. If it just were to run out its course and not ever bring on a new customer, the cash flows that are generated consistently, assuming competition didn't interfere, blah, 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 it's got some impressive economics is the point.
Based on its earnings relative to its cash
independent of the earnings. Just bring the cash flows through the company. Yep.
Okay.
Does that help?
Yeah,
Okay. Yeah.
You talk a lot about things being cheap for a temporary reason. Is there any particular reason why it's so cheap?
Yeah. Good point. I think Neutral Tandem it has a significant. It's probably got about 20% short interest. So the shorts for starting last September, starting around the time that the stock started to fall, started to be a lot of shorting of the stock going on. And here's my take on the shorting. Number one, shorting, 10 years ago, I think people had a lot of respect for the shorts, as they should. Shorts in general, everybody knows what short selling is, I presume, right? Yeah, shorts in general do a thankless job. Some of the first guys helped identify Enron, WorldCom. Those are not the guys shorting Neutral Tandem, though. In the last 5 years, it's just become too easy to short. So while you have very rational long investors and very irrational long investors, you also these days have a lot of irrational short investors, irrational and irrational. The point being, Neutral Tandem was a great short at $36 a share for a couple reasons. The business is hard to understand, so a lot of people who didn't understand the business would buy it. If things start to fall, they assume nothing's going on, they'll sell. It's also fairly thinly traded, meaning there weren't a lot of shares that traded hands every day. And in a thinly traded market, it's sometimes easier to short things because you're moving the market as you're shorting things. The third factor is that Neutral Tandem was a venture capital-backed company. The VCs were the ones, insiders that were VCs that were selling their shares. So if you're a short a couple months back and you're looking for candidates, Neutral Tandem is probably a great candidate because their business is hard to understand. You can just tell looking at the history of filings that there's going to be more sales by the venture capital backers before too long, and you can get ahead of that. You can start shorting, and it almost kind of compounds itself. So it's fairly technical reasons, though, not competitive, and that's the distinction in my head.
So you're imagining, aside from it being a good business, you're imagining at some point in the future the speculation might kind of die down, and then the market will recognize the value again.
We're seeing that already. Yep, we're seeing that already. I had an interview on a reasonably popular website about Neutral Tandem specifically, and went through the whole investment case for it. And I had nothing to do with the subsequent rise in the share price afterwards, but the fact was that it seemed to come on a lot of value investors' radar screens around the same time because it was so cheap. And the short interest has been falling the last week and a half because of that, I think. Bottom line is, after all this analysis, Neutral Tandem is one of those. It's about 7.5% of the target portfolio right now. So clearly, I could be horribly, unequivocally, very wrong about the company's outcome, their future. I don't think I am. I think the odds are on my side. It's a large, not our largest, but it is now in the large end of the spectrum as far as holdings for us. This is sort of summarizes the bottom line in terms of value investing specifically. Seth Klarman, another well-known value investor, just underscoring the need to ignore the noise and focus on buying good companies that you want to hold for a long time. My last tip to you guys is start investing early. It doesn't have to be with me. You probably can't be with me, but the point is the economics, that magic of compounding interest is really something to behold. The earlier you start investing, even if it's just, in this instance, a couple $1,000s for each year for 4 years, it is magical how that can accrue over time. I knew all this around the same time. I didn't do it. I guess I'm trying to say you guys do it because I didn't do it, and it still worked out okay. But the reality is, the earlier you start, the better things will be. Yeah, I think in terms of I would label, if I had to categorize them, I'd say return on equity is probably the most significant. Just in terms of, if you don't have a proxy for, or if you're not actually figuring out returns on invested capital, I'd say the return on equity is probably the next most reasonable proxy to go. And each applies differently to different companies.
Like it's Walmart.
Yeah, I think return on equity is a reasonably good proxy for the internal economics of Walmart. It wouldn't be for a bank or financial institution, for instance.
So if they were above industry average,
yeah, anything north of 15% consistently, year after year after year for 10 years. If it's above 15%, then that could also be a sign that there's a competitive advantage somewhere in there. The problem with using return on equity is that can be influenced a lot by debt. If a company has a lot of debt, that can also boost that return on equity. So you just need to keep both in mind. The reason, honestly, I like using return on invested capital is that it accounts for that debt. It's built into the formula already, if you will, which is why one of the reasons I like using it.
I'm sorry, actually, before you go on, another thing that I found strange about them is their current ratio is actually very low.
Mm-hmm.
And it's not even at 1. So I'm wondering why they would do that.
Yeah, it's just it simply affects their cash flows. The bottom line, well, there's a sort of cynical answer and there's an operational answer. The cynical answer could be that the company knows that the analysts are paying very close attention to its cash flows, and that working capital management is a big determinant of what the cash flows look like at the end of every quarter. So if it's something this is the cynical answer. If it's something people are watching, if you're getting measured by it, you're going to react to do it. The other answer is the systems are that good. If you look at a company like Dell, for instance, also needed very little cash just to get things going in their prime because the supply chain was so good, the inventory was so good, and they can really just turn around on a dime. They're also able to get money in from all their vendors fairly quickly, and they're able to delay money coming out to all their suppliers because they are who they are. They're Walmart, and you're just not going to mess with them. So they can
There's
put it this way.
very little concern that all of a sudden everyone's going to want their money the same day. So
Not if it's Walmart, yeah. If it's Walmart, you can be assured that they're doing it intentionally because they know who they are, and it's just a matter of freeing up enough cash to redeploy in other places, I guess, is the way to think about it. Yeah. I wouldn't put a whole lot of stake on return on assets. Although I would probably categorize it less important in Walmart's case than return on equity. It's probably a second, probably second tier, close to ROE. Return on sales, was that the third one you asked? Yeah. I don't do anything with that. I think a lot of growth investors probably do some metrics with return on sales. And I guess it arguably would be valuable if the company weren't profitable, but you still wanted some sort of return figure. Then you could plug in sales instead, but I wouldn't think it's that relevant for Walmart specifically. Does that help? Okay. Do I get credit for that?
Sure. We'll put a footnote in there.
All right. Anybody else? Yep.
You just mentioned that you invest in total 15 stocks.
Mm-hmm.
So how many industries are those stocks?
Yeah, good point. They're fairly spread out, and that's part of the portfolio management aspect that I didn't get into here, but I am conscious of trying to select, most of the time, different companies in different industries to still benefit from the limited diversification I have, if that makes any sense. I don't want this to be an all financial fund and all tech fund, so I'm consciously figuring out, okay, well, I like something in industrials. We got companies in industrials, we got some companies in tech, we got some consumer discretionary companies. So we're covering the gamut. There is one exception, though. I don't do anything in healthcare. I don't have anything, well, it's not true. We own a healthcare company called Alcon that is in the process of getting bought by Novartis. I didn't buy it because I'm an expert in healthcare by any means. Otherwise, I would not do anything in healthcare. But Alcon was a special situation. It was going to be bought out eventually. It was just a matter of time. I was willing to be patient. Others weren't. And we've done quite well because of it. I probably will still leave those shares in Novartis shares because once the transaction happens, because Novartis, my limited understanding of healthcare still seems to think Novartis is still undervalued right now. So the answer is, I don't have the exact number, but a reasonable enough grouping of industries that I feel like we're not over weighted in anything. With the exception of telecom, right now we're probably a little heavier in telecom than I would otherwise be, but otherwise it's fairly spread out on purpose.
Do you have a benchmark?
S&P 500 is the benchmark we use. Doesn't matter though. I mean, people want to use the Russell 2000 small cap. Has not been an issue so far. We're still doing very well by all benchmarks.
Now, a lot of these are fairly small companies. There's some big ones in there, but some of them
Yes.
are pretty small.
Yep.
As you are successful and you have 90% return followed by 90% return, year after year,
Yes.
You're going to discover, that you're going to have to figure out how to redeploy money. Have you thought about sort of what that's going to look like?
Yeah, great point. What the professor's getting at, I think everybody understands, is that the bigger my fund gets, the harder it is to take meaningful positions in some of the smaller companies without, either moving the stock price around or whatever. And the answer right now is I'm okay with that for the foreseeable future, just because most of the values I'm finding are in the large cap part of the market right now. There are some really, in terms of relative valuation, which I don't put a whole lot of credence into, I would be okay right now if everything were in large caps. But no, it's something that, put it this way, when we're $1 billion fund, it's going to be a great problem to have to figure out how to still get in those smaller names, but it will unequivocally impact the returns of the portfolio. We will get better returns in smaller companies, yes.
How many assets under management now, roughly?
We got 7 million, yeah. So I can go basically anywhere I want to go. There's some places I don't do a lot of, I don't do any over-the-counter stuff, pink sheet silliness, but yeah. But yeah, I can go anywhere.
If you're a $1 billion fund, it's going to be hard to put 7.5% quickly and neutral.
Exactly. Yes. Great point. Yep. It will affect our returns. Our returns will be lower. Our outperformance will be lower simply because the smaller part of the market is where the biggest inefficiencies are, I think. Yeah.
Just as harking back to the whole diversification thing, obviously I've read your thoughts on it, and I've read like Buffett's thoughts on diversifying. And it's really interesting how you only have 15, 16 stocks, and I watched the performance of the folio. I don't think I've ever seen it since I've been invested going contrary to the market. So it's still following the market. It's just slightly steeper on the way up and on the way down. But
Yep. It's a good.
It does seem like there's definitely enough diversification even in such a small amount of stocks.
Yeah, it's anybody. Last year it was an unusual example in a lot of cases, but it didn't really take a genius to outperform last year. If you bought some reasonably good companies that seemed overvalued, it's not hard to outperform in a rising market. The trick is, though, is to do both. It's to outperform in a rising market and still have the portfolio in good enough companies defensive enough names, if you will, which I don't really like, that should the market fall, you're falling less fast than the market. Because the downside of owning just 15 companies is that things are a lot more volatile. I mean, it will go up and down a lot more than the index fund by definition. But I also don't view that volatility as a risk. It's probably a whole other discussion. The risk to me is more, what are the odds I'm going to lose this entire investment, or that it's going to be permanently impaired and I'll never be able to pull any money out. So I can live with volatility, and to the extent I think to outperform you're going to have to. The trick is, though, that you're not just throwing darts at the board, and you've got a strategy for helping outperform in down markets too, just falling less. Okay, I think you guys better get to class or something. Taking up time. Thank you very much for coming by.
Thank you.
Appreciate it.
Thank you.
All right, thanks.